Welcome, everyone, and thank you for joining us for today's Oxys Corporate Performance Series webinar, Post-Merger Integration, Keys to a Successful Acquisition Integration. My name is Virginia Yarcy, and I will be your monitor today. I'd like to start by introducing our speaker. John Stunson is a director at Oxys with over 17 years experience in Fortune 500 international organizations and Big Four professional services. John has worked with C-level executives to analyze complex business issues, develop business strategy, and implement change initiatives. John's experience includes multiple successful migrations of finance and accounting, operational functions to shared service centers, leading merger integration initiatives, and developing growth strategies for board of directors. John is a certified public accountant and a certified management accountant. He owns degrees in accounting and operations management from Boston College. Before we begin, let me remind all attendees, we welcome your questions. Please submit them in your webinar panel area at any time. We will be addressing questions at the conclusion of the webinar. Also, this webinar qualifies for CPE credit. Please watch for random interactions and polls as required by NASBA compliance for issuing the credit. And with that, I'll turn it over to our speaker, John Stunson. John?
Hi, good afternoon. As Virginia mentioned, my name is John Stunson. I'm a Director of Business Transformation and Compliance for Oxys. I've been in consulting in one form or fashion, internal and external, for 17 years. During this experience, I've worked on or witnessed a number of integrations, or in some cases what I would call integration attempts. So let's dive into the agenda. So we're going to start with some reasons for integration failure. Then we're going to dive into keys to success. We'll start with structure and an effective integration management office, an IMO. Lead into define a disciplined integration approach. Next will be define and mitigate risks by workstream. Finally, we'll have design and execute and track synergies. We'll follow that with some key takeaways and have a Q&A. With that, we'll start with our first poll as required by NASBA, but we'll talk to some of these polls, so I'll let Virginia take it away.
Thank you, John. Our first poll is what percentage of integrations fail? And we have four possibilities: 10%, 25%, 50%, and 90%. So we'll take a few moments to allow our participants to engage in the answers, and then we'll give the results. Okay, almost. Okay, we're going to go ahead and close the poll and check our results. We do have three different possibilities here. 22% of our audience is looking at 25% of integrations failing, and another 22% feel that 90%, that's a lot, are failing. None considered 10%, but the majority, John, are looking at 50% of integrations failing. That's 56% of our audience.
Well, it sounds like our audience knows their stuff. Research indicates that M&A activity has an overall success rate of about 50%. As a management consultant in one way or another for the last 17 years, I've run into a lot of companies who've had failed acquisitions. Many times management has taken a reactive approach and thrown together a skeleton crew to quote-unquote bolt on an acquisition. Oftentimes these skeleton crews are only looking to perform the very basic functional requirements to keep the ship moving. Things like changing bank accounts, financial reporting alignment, making payments, maybe consolidating a facility. Those type of things are generally some of the low-hanging fruit in integration. But oftentimes management fails to take a proactive, comprehensive approach in designing an integration plan. Without implementing this approach, many companies can fail, quote-unquote fail. I think fail is very subjective, but let's dive into what we mean by an integration failing. Effects are operational interruption, high turnover, damages to a reputation or culture, process inefficiency, and unrealized synergies. Disruption to the business. Many times companies don't consider the risk and resulting consequences which result from a merger. We're going to cover this in our risk mitigation piece. Additionally, they can leave a truckload of money on the table with synergies not realized. Though they may get to some of these savings later on, there's an opportunity cost to not really realizing these synergies as soon as possible. We cover this later in our synergy section. High turnover, it's been my experience that high turnover can really cripple your business, especially in a critical time like integration. This sometimes can be so easily avoided just by communicating early and often. Damages to reputation, this is fairly intuitive. Hurting your culture, damages to your reputation is affecting your business. And then process inefficiency. So why don't many companies get proactive with post-merger integration? A lot has to do with normal human behavior. So let's look into some of these causes. So left to our own discretion, management ranks of both organizations will resist many of the changes required to make the acquisition successful. What we find is there's a natural state of inertia, a resistance to change, and obviously the nature of an integration and acquisition is change-based. Next is failure to articulate a clear picture of the end state operations of the business. What business results do you want? If these are not communicated, this can have a severe impact. Failure to define specific results, as we discussed. Failure to define an organizational construct. Sometimes there's no communication as to what's the future state of the organizational construct going to be. Processes have not been integrated. People work in silos with redundancy, oftentimes adverse scenarios. Also, finally, human behavior chimes in. People don't want to reveal their operation in a lot of cases. They don't want to receive unwanted attention. Everybody has seen before an insecure manager of a function that's very defensive and doesn't want people checking under the hood, if you will. And sometimes they reveal that there's a severe lack of competency in that operation. So those barriers put up by that human nature really has an impact. Okay, so this is why a lot of acquisition integrations fail. So next we're going to dive into what's an effective structure for an integration, what we call an integration management office. First I want to start with our planning mission statement for integration. So before we get started in the structure, let's talk about, what's our guardrails, what's our mission statement for this integration. I think that first and foremost we should say sustain positive momentum and do not disrupt the business. Should be our ultimate mandate. Next, the integration is going to be a challenge. It's going to be very hard for many people involved, the entire organization in a lot of cases. Change always is, and there's always this resistance to change. So we should expect this. We want to integrate the two organizations as rapidly as possible. The faster you perform the integration, the sooner you can capture synergies, and you can focus on your combined organization's operations later. You can use small teams with strong critical players, with some functional knowledge in multiple areas. All best practices are open to be leveraged regardless of the org. No one company has the gospel approach. No one company is going to be the one we're going to leverage all of their approaches. You should really leverage best practices. Obviously, if you're going to acquire an operation, there's some good that you see in them, and you want to leverage those best practices where possible. Next, communicate. Limit unnecessary impacts of the rumor mill. Issue communications fast so they can be dealt with ASAP. Employers, vendors, customers all need to be communicated with. This is why we have a day one communication plan. This is why every major org announcement is addressed and disseminated across the organization. Additionally, ensure people are redeployed to work activities that add real value. Okay, let's dive into the construct of an effective M&A team. I've had a fair amount of success with this actual structure. Not every M&A team is structured this way. This is what we feel is a very strong structure. You start with the steering committee. This can be your executive management, generally incorporated with the M&A team. Executive management provides governance, they provide high-level guidelines, and provide the ultimate issue resolution for some critical issues. Generally, a steering committee meeting will meet one every week or every 2 weeks, depending on the timing and the nature of the integration. Excuse me. Additionally, the executive management that is generally in there, you say for the last example of an integration I had, you have the CFO, you have the managing director, you have the VP of sales, you have both the acquired firm as well as the acquiring firm executive management as well. So very key decision makers at the steering committee level. So now the integration management office, the quote-unquote IMO, is essentially the program manager for the integration who plays point. Coordination, overall project management, status report consolidation from Workstream, tracking, reporting, steering committee presentations, etc. These are all done by the IMO. Also, issue qualifications are performed by the IMO. What we say is the IMO is the critical linchpin for the integration, is generally the face of the project. Items are funneled in and out of the IMO, as the IMO is critical to controlling information flow. Next, we have Workstream Leads. Each major function will generally have a team assigned with a Workstream leader to play point for that particular workstream. The Workstream leader generally has significant knowledge in the functional area and is able to perform project management duties in addition to providing actual support for the integration, performing the actual duties required to integrate. So under the Workstream leads are the Workstream teams. These individuals will analyze current and future states. They'll design, they'll plan, and they'll execute the actual integration. So here's your arms and legs from various, there could be members from the acquired team, there can be consultants, there can be members from the acquiring teams. Generally incorporates all three. Okay, moving on to the next slide is M&A team role. What are the strategy and tactics for an M&A team role? There are many activities that the M&A team will perform. The following illustration helps us show what those may be and what the purpose they serve. From a leadership/foundational standpoint, the M&A team, mainly the IMO and Workstream leads, will perform the following: project plans, facilitated workshops. These facilitated workshops are performed to gain alignment to basically draw up a project plan or actually further expand upon it and drill down. Additionally, a cutover process is critical. These are day one activities, handoff plans. Generally, we have what is called a day one checklist that are things that need to happen before or actually on the day of integration. Very, very critical to the success of an organization. Additionally, the IMO will have steering committee presentations. These, like we mentioned, are could be done every 2 weeks or every week as needed. Sometimes you have to do emergency ones as issues arise. However, it's generally my experience that every 2 weeks is sufficient. Excuse me. And then the IMO also does status updates, synergy, cost to track, synergy tracking, cost to integrate tracking. Also, various other presentations for executive management, vendors, or customers. So issues are going to come up, no doubt, in integration, as they always do. There's always going to be these ad hoc presentations that the IMO will pretty much have to, run around and put out fires here and there, or address issues. So that is pretty much more of the foundational support and leadership side of things. Getting more into technical side with the Workstream leads, we have Workstream meeting minutes. Generally, we have Workstream meetings, I would say, once a week, maybe twice a week, depending on the nature of the integration. The Workstream leads are managing the key milestones, such as project plans or detailed action items that are documented in the minutes, functional management presentations or proposals. Additionally, what we have is, let me see here, performing, evaluating, and managing training. This is a very critical process I'd like to get into. On a previous client, this work stream proved to be exceptionally valuable to ensure knowledge transfer. This is a real easy one to let slip through the cracks, but the value obtained from onboarding your people, effectively training them, all the new hires that may come out of it, or the new systems or the new processes. If you don't have effective training and accountability in training to make sure your people are effectively trained, there's a lot of impacts to that, such as turnover. People will get into a new job, and say, no, this is just not for me. Nobody's helping me out. I'm on an island, that type of thing. Or they're just going to hide and avoid any accountability. So training is very critical. Additionally, ensuring resources / support is provided. So things simple that may slip through the cracks, such as having the right IT access, making sure the logistics people are set up effectively, those type of things. And then finally, we have, for tactical support, is to act as an extension of your organization. Do the actual arms and legs work that may arise. At a previous integration, customer service turned into a very serious bottleneck at a moment. One of our consultants was made available, in this case, to facilitate the process and avoid disruption to the business, which ultimately is the first mandate of the integration: avoid disruption to the business. Okay, with that, let's dive into our second poll. Thank you, Virginia.
Okay. Thank you, John. Our second poll is, what do you think is the most effective team structure for an integration? And we have three choices: internal employees, external consultants, or a hybrid approach. So let's give it a few more, about 10 more seconds to please enter your answers. And we also appreciate your participation. Okay, let's check our results. Right, well, it looks like we have 100% hybrid. I think, John, you're doing a great job, because that looks like the good answer. Okay, take it away, John.
Well, I think everybody nailed it. So over the years, I've seen a number of approaches to performing an integration. I've seen nearly entirely third-party. I've seen entirely internal. And I've seen the hybrid approach, which incorporates a structured element of both internal and external parties. I'm partial to the hybrid approach because of these reasons. Limited disruption to the business, which should absolutely be a priority. It's enabled by using a third party devoted to integration and leaving people to focus on their jobs, but also participate in the integration, but still have the mandate of performing their day jobs. Additionally, you can leverage integration expertise. For many companies, do not have integration expert, and they don't know how to structure a team. They don't know how to look for synergies. They don't know how to put together a risk mitigation plan. But they do have functional and company-specific knowledge that certainly the integration team needs to leverage. Additionally, focus. An integration team should be solely focused on the integration. An integration should be performed effectively and quickly. No other responsibility. When you hire a full-time consultant, that is a responsibility. They're going to be laser focused on the integration. Additionally, flexibility. Each work stream can be different and have different durations. For example, sales and marketing for a particular company may have a 3-month integration timeline because you have different channels and there really isn't much overlap. Whereby supply chain may be able to leverage some of the same warehouses, maybe able to leverage purchase volume. There might be some excellent synergies or a lot of work to be done, so that may take 8 months. My personal belief that the main detriments with using internally only run integration is that the assigned integration team is often distracted by their existing job duties, which may prolong or affect the integration. Additionally, an internal team may think to capture certain synergies, but they may not know all synergies. They may not be able to capture a number of things that they just haven't had the experience of. So even though there may be less of an immediate cash outlay for external consultants, the company may lose money in the end by not capturing synergies or prolonging the integration. From discussions I've had as of late, and we're entering into a more prolific M&A era, as you know, using a bolt-on internal acquisition team is happening quite a bit, and it's actually leading to a lot of failures. And I'm not sitting here just advocating for using consultants, but I would recommend that a proactive, comprehensive approach be applied to an integration, and that design and planning is a strong consideration and focus. And it's been my experience that many companies just don't have an assigned integration team that they're willing to keep on the payroll full time. Okay, so let's move into the next slide. And this actually just kind of reiterates some of the responsibilities we talked about with the Integration Management Office. I think these merit another look. The responsibilities of the IMO is to create the integration plan and process, provide planning and project management tools, track overall integration implementation, maintain a high-level project plan to monitor and ensure the major activities of the work streams, facilitate weekly quote-unquote rhythm meetings with Workstream Leads to monitor progress, track results, communicate progress, and escalate necessary issues to the steering committee. That term rhythm it's a funny term. One of my previous clients did not really like it, but we couldn't come up with another terminology for it. Project status, provide executive steering committee with regular status reports on the PMI. Project leadership is very critical. Facilitate assignment of leaders, tasks, deadlines, priorities, capture functional teams, merger synergies, as well as cost to integrate. For most mergers and acquisitions, I would say that synergies sometimes take a separate work stream. They generally have a separate work stream, but it's very important to be constantly communicating where those synergies are and what are the costs outlaid to achieve them. Next slide is the responsibilities of the Workstream Leads. This is obviously much more tactical, and this is where the integration work is performed. Develop the initial workstream charter and action plan, deliver workstream integration results on target and on time. Where financial synergies are identified, clearly understand the actions necessary and execute upon them. Update tracking tools on a weekly basis. This is a good point. Represent workstream in weekly report out meetings. Listen in on other teams reporting out in order to bring vital information back to the team. So when you're in a workstream, you're a workstream lead. You need to participate in cross-functional teams where you're discussing the impacts, say for HR on a finance. Say we have a number of people to be hired. We need to know where the HR team is on their hiring plan. There's a lot of cross-functional items going on in an integration, and it's very critical that the workstream leads are talking to each other, talking to the IMO, and then the IMO communicating up to the steering committee, and then that information flowing back down. But cross-functional teams are exactly that. They need to be communicating with each other. Working in silos will make an integration fail. They call team meetings, conference calls as needed to ensure accurate and timely communication, constantly monitoring the action plan, and they need to be on call for individual members to clarify action plans or address questions. Workstream leads are the project managers for that particular function. Okay, so now that we've defined the IMO structure, let's talk about the integration approach. We find that when considering M&A, it should be broken out in two main phases, design and integration. Design includes 3 steps: operational due diligence, strategic assessment, location design and solution design, and then integration is integration. This slide represents the overall M&A approach and is referenced at the top right of the accompanying slide. This is your main map of integration. We're going to dive into each step, and the information below each step is kind of the actions that you'll be performing in each step. I won't get into that detail, but we'll cover those in each step. But this is a good basic document that basically shows the whole integration approach. Okay, operational due diligence. Many companies do not take a structured approach to this whole cycle. Specifically, we find operational due diligence to be somewhat lacking. Financial due diligence, however, is much more prevalent. A company wants to ensure and have an external opinion on that the assets they are buying are truly in existence. This is more of what financial due diligence is about. How, confirming AR, confirming inventory, and confirming fixed assets, get an auditor's opinion on that. Operational due diligence is to gain an understanding of what is actually being purchased. What are the processes in place? How do the systems interact? How are they utilized? What is the organizational structure? How do departments interact? Ultimately, this effort is to confirm what you have in operation before it's purchased. Personally, I believe this step serves many purposes outside of validation, as it allows an organization to really begin to formulate an effective integration strategy early in the M&A cycle. Okay. Next slide is the strategic assessment. The strategic assessment works to, quote-unquote, find the value in both operations. Generally, a deeper dive into business processes, people, and systems are performed for both operations to identify and quantify key opportunities for the future. In order to develop this deeper dive understanding, generally process maps, activity inventories, IT systems inventories, org charts are obtained or generated. In some cases, you might have to draw up process maps if the company doesn't have process documentation. Generally, you have to chop up an activity analysis, which dives into not only the specific activities performed, but what's the nature of those activities. Then you want to dive into what we call a resource allocation analysis. So from all this data, we can perform some analysis which is really telling. Resource allocation analysis and activity analysis are really valuable tools. In a resource analysis, you are able to understand how many resources contribute to a particular function, which can often be surprising. Oftentimes, too many handoffs, too many chefs can cause undue complication to a function. Generally with this, we note opportunities through specialization come out of this. So for example, I had a previous client and they had a lot of decentralized operations in particular countries, and they had their own accounting shops in those particular countries. But they were small enough where the accounting folks, wore a whole bunch of different hats. They would be doing AP, they would be doing FP&A, they would be doing accounting. There were segregation of duties issues, but also there was so many activities being performed that whatever inefficiencies there were kind of being hidden in a way because the person was doing so many different roles. So ultimately, when we're looking at a future state role, and we'll get to this, we see specialization as an opportunity for efficiency. So at the end of a strategic assessment, the M&A team should have a clear understanding of where the operation's strengths, weaknesses, and opportunities and threats are. Okay. So the first part of our design is talking about a location viability analysis. Generally, when two companies merge, there are obviously certain redundancies. Facilities is generally the most obvious. Oftentimes, a location analysis should be performed for an objective review where a future state operation should be located. This does not necessarily mean utilizing the acquirer's facilities. I've seen a number of integrations where the firm acquired ended up as the corporate headquarters in the future state. I mean, things like, how expensive the lease is, where's the operation. Those factors come into play. We like to apply a quantitative analysis to this, and we can show you here some of those factors. Essentially, we incorporate a number of factors and we weigh them, quantitative and qualitative factors, and develop a recommendation which is similar to a scorecard. So things like cost of labor, cost of operations, availability of labor, political and economic environment, employment rates, workforce education, all those things play into a location analysis. It doesn't necessarily have to be strictly corporate headquarters. Regional locations are often applied here. And also the operations of the company. Look at Office Depot and Office Max right now. Certainly there's synergies and analysis being performed when an Office Depot is 3 blocks away from an Office Max. Certainly there can be some redundancy there. I'm sure they're looking at opportunities right now. That's somewhat of a $400 million integration from what I'm told. It's pretty amazing. Anyway, the location analysis is a unique aspect of the whole overall design phase. Let's get into a little bit more about what design is. So this is where you incorporate all your information that you've obtained during your operational due diligence, your strategic assessment, your location analysis, and you're basically drawing up the future state of the organization. You're going to draw up the organizational design, which is basically the org chart that you anticipate in the future. You're going to draw up 2B process maps. What are the future state processes that you're going to employ? What are going to be the future state IT systems? All this information is somewhat driven by some quantitative data. Volumetric data is very important in deciding 2B scenarios, future state scenarios. Say, for example, you have a Madison, Wisconsin operation that processes invoices. Say maybe they got 10 people and they're processing 1,200 invoices a month. And then you have a Miami operation that has 6 people and they're processing 1,000 invoices a month. And assuming that the level of complexity is given the same, you're going to find that the Miami operation is run more efficiently. Therefore, you can leverage that data and obviously some of the process design that you've done to generate an organizational design in the future state. So we find that volumetric data is very telling. You can't hide behind the fact that this is how many documents are processed, this is how many transactions are performed, this is how many invoices are paid from the volumetric data, and they're very telling in defining a new organization. Okay? So what's the main focal point of an integration is going to be the project plan. This is probably pretty obvious to some, but I would say that this is your one document that you need to be focused on at all times. It's discussed at almost every meeting, and it basically limits costly surprises and critical errors. Requires timely decisions in order to make deadlines, requires adjustments which are communicated when unforeseen roadblocks arise. Additionally, in a project plan, you're going to sometimes incorporate what we call a phased approach, where, say you have country integrations that need to be performed, or department or functional integrations that need to be performed. Maybe you have to use a phased approach because you have resource constraints. Maybe you want to prioritize those in such a way that you can leverage that experience from your M&A team, so you're not having to do a big bang approach. So we found a phased approach is very effective. The factors considered when prioritizing using a phased approach are resource availability, your organizational bandwidth, the sales by the region or segment that we're talking about. If you have an extremely profitable or high sales region, you want to focus on that first, just to make sure you capture the synergies, you get it integrated effectively initially. Additionally, other things come into play, such as system complexity. Additionally is regulatory constraints. Sometimes you have to integrate something sooner because you have some type of regulatory constraint around it. Additionally, say you have corporate headquarters leases that are about to be performed. You have to structure the action plan, the project plan around that as well. Here's some examples of, well, we'll get into this. This is the actual integration. This is some of the key workstream actual activities we can dive into. For finance and accounting and IT, when implementing redesign finance and accounting processes, you need to hire and train. You need to stabilize the 2B finance and accounting process design. and you got to constantly monitor and measure process performance. For IT, you need to convert, configure, extend, migrate, or implement applications based on your architectural design that you came up with. Finally, in finance, obviously, this is very important for management, especially public companies. You need to develop financial consolidation and reporting processes that are going to effectively enable you to communicate in timely and based on your regulatory mandates. For supply chain, redesign and standardize processes based on a number of different factors. You can eliminate redundancy with unnecessary processes. You can leverage your increased purchasing volume that you may have from some of the same vendors that you most likely will have. Generally, when you acquire a firm, those are the type of synergies that you find attractive, and you can leverage that increased purchasing volume. A company that I was just working on, they basically were a restaurateur, and of course they had a Pepsi contract, and they were able to leverage that volume with the other company that had that contract. They had a more favorable terms, so they were able to save a ton of money. Optimize supplier and vendor terms and agreements, another thing, and identify other synergies that come about, such as redundant warehouses if you have similar ones in the same location. HR and facilities. I tend to find HR probably being the most important work stream, just because effects that can happen in HR can really cripple your business. So designing the future state operation is very critical. So hiring, terminating, migrating, training are all determined in your future state design and executed in integration. You need to quantify, obtain, and track headcount synergies, quantify, realize, and track cost to integrate. Severance is this cost to integrate in most cases. Additionally, this is no walk in the park because severance in some cases can be very complicated. I've worked a lot in Latin America, and their labor laws around severance are pretty, I would say, intricate. Additionally, employment agreements need to be generated. Are often generated because you want to retain existing staff that you have. You sometimes give retention bonuses, stay-on bonuses, etc. Sometimes you plan to terminate someone, but you want to make sure that they're there for the entire integration, and that's when you apply a stay-on bonus. Additionally, the facilities transition is one of the easier, the lower-hanging fruit of an integration, but it's no walk in the park either, with a lot of complications arising from getting in and out of leases and existing facilities. Other work streams are such as legal, sales and marketing, and even just the travel and expenses need to be considered. Sales and marketing is a pretty neat work stream in that there's some revenue synergies to consider. Perhaps you're buying a company that shares the same one of the same customers, and you haven't been able to access that customer in an existing region or country. Obviously, a softer introduction will most likely lead to increased or improved or any sales in that particular customer. We've done some pretty cool things in revenue synergies at a lot of the companies I've worked for in integrations, and it's pretty nice to see. It's not all focused on cost reduction. Okay, so the next phase is define and mitigate risks by workstream. This should be a vital consideration for every IMO workstream lead. Oftentimes I find that risk mitigation is not a focal point for an integration, but it absolutely should be. It should mold the design of an integration because your objectives are to ensure a smooth transition and operational effectiveness. You want to have minimal disruption to the business, little to no impact on customer service. You have to maintain your internal controls and fully comply with external regulations and reporting requirements. Additionally, you want to minimize labor and legal risk associated with planning and implementation. You want to minimize and control cost to integrate expenditures. You want to minimize unanticipated turnover and retain high-performing staff. One of the key risks of an integration. So here's an example of a risk mitigation plan that we drew up, and this may not be one-to-one pertinent to your business, but I can pretty much guarantee that some of these risks would definitely apply. For example, key business, technical, and country-specific resources may leave the company prior to completion of integration. This is risk number 3. This is a transitional risk. We have other risks that are, say, operational or governance. But the likelihood of this is a medium, potentially medium or high, depending on the integration. But the impact is high. So generally, this is an example of a mitigation plan that we put out in front of the steering committee before in the design phase, and we put processes in place to address these risks as of day one or even before. So you identify the key resources and put retention plans into place. You implement strong communication processes to reduce speculation. You ensure the managers of these key employees hold retention as a mandate. So these type of things, obviously there's a process in place for retention, but the rest, if you've noticed, is more about communication. And these type of things are easily ignored, but they can have a huge impact on your business. Okay. Some other risks, escalating costs from severance, retention bonuses, retraining, outplacement in staffing firms. Country-specific regulations are always very important. If you don't comply with those, if you don't pay attention to those, you can really get hurt. Obviously you can understand the power of the government in any region or country. It could have real consequences. So with that said, let's take our third and final poll.
All right. Thank you very much, John. Very interesting. I'm going to launch the third poll. What is the biggest risk during an integration? Select which answer you feel is the biggest risk. We have critical turnover, operational disruption, failure to comply with key regulations, and failure to realize synergies. Now, if you choose other, please use your panel area and let us know what you would consider another biggest risk, if you will. Okay, we'll just take another 5 or 10 seconds to get our answers. Okay, thank you everyone for participating in the poll, and let's share these results. We do have a variety of results here. John, you can see critical turnover, some 10%, 10% for failure to comply with key regulations, 20% for failure to realize synergies, and the highest percent of our group says operational disruption. John?
Okay. Well, thank you. That's a good mix. I certainly agree that operational disruption would be probably the highest, but I would not ignore, as a secondary kind of a hidden one in there is the key regulations. I'll give you an example. A company that I knew of, I'll say knew of, bought another company, and this company was a government contractor. During the operational due diligence phase, I don't believe they performed an operational due diligence, quite honestly. I think they did financial due diligence. They didn't look at this particular government contractor's adherence to government regulations. These government regulations were not necessarily being followed to the T or up to snuff in accordance with the government auditors, and essentially their business is coming close to being crippled or actually put on hold because of this failure to comply, and they're spending millions of dollars to recover in the backlash of these deficiencies that were noted. So, $100 million acquisition is crippled in the first year because of a regulatory compliance issue that wasn't necessarily noted. So that there can be some, it may not be as prevalent, but that could be some very high impact. Obviously, that leads to operational disruption. Okay, so let's get to the final key to success, as design, execute, and track synergies. So in an effective stages in the integration lifecycle, we start with preserve value. Obviously, you want to maintain your purchase value. You generally run current operations separately initially. You want to focus on retaining key employees, developing interim organizations. You want to have some band-aids, basically, not band-aids per se, but just some mechanisms in place to effectively report. And you want to definitely focus on clearing focused communication, especially to retain your existing employees. Next phase is realizing value. This is where you start earning your money for the integration. You're realizing those synergies that, say, the acquirer really banked on, or even if it's backed by a private equity fund or something that's really looking for to pay for the acquisition. So consolidation of opportunities, the integration of operations with common processes, systems, compensation programs, policies and benefits, and then you want to exploit those best practices from either operation that we talked about. And then finally, once you've stabilized and realized those synergies, you can start optimizing, creating value from that future state vision that you have of the operation. You can execute cross-selling opportunities, you can expand your brand, you can geographically expand, you can innovate new products. That's when you've already done the previous phases and you feel comfortable with your future state org. Then you can focus on creating value. So generally within integration you have two main work streams: operational integration, which we've been discussing, and then you have a synergy work stream. Operational integration is focused on organizational design, day one planning, things like customer and vendor terms, financial reporting, budgeted, things you have to do to successfully integrate. The other work stream is synergies, is basically harnessing the potential, the monetary value from a effectively designed organization, incorporating both. Okay, so effective synergy identification, planning, and realization is critical to success. Synergy identification, focus on identification during current state operations review. That strategic assessment, we should really be gaining an understanding of where these synergies will be when you're evaluating both operations. Generally, synergistic areas include purchasing, where you leverage increased purchasing volume. We touched on that with, I guess, the Pepsi contract that we talked about. Headcount, we talked about leveraging similar roles and responsibilities. Obviously, when one company buys another, you're able to get more efficient. So 10 people plus, it's not necessarily 10 people plus 10 people equals 20. You're going to maybe go 10 people plus 10 people with some efficiency, span of control capabilities, and process enhancement. Maybe you get to 15. Warehousing, you might be able to eliminate redundant operations. Customer and vendor terms and agreements. Maybe you're able to leverage favorable agreements. Maybe in some cases you could have what we could call a negative synergy, where your customer wants to leverage their favorable agreements. So you need to be careful of that. And then applications and IT infrastructure. Say you're an IT outsourcer and you have a great contract where you've been able to reduce some 30% of your cost. Perhaps that contract can be expanded into the new operation you're acquiring, and you can save money on your IT that way. So that's the synergy identification piece. Next is synergy realization. You need to develop project plans for each synergy, and you got to execute a plan using your assigned resources, generally your workstream team. And then obviously you want to track the synergy. This is definitely an underrated part of the synergy workstream, because these type of things really provide value to the executive management, those who decided on performing this acquisition. So more like, see, these are the costs that these are the synergies we're realizing. Here's what we paid for those synergies. Say, this is the cost to integrate, but here's the output of your efforts. Here's what we've been able to harness. I particularly like this phase, this work stream, just because you feel like you're adding real value to the operation. You're providing some real money to the operation. It's pretty neat. So much so, when I was at an integration, I was in charge of the Synergy Workstream. I used to hold a Synergy meeting once a week, and we would go through all these things, and I would track them. We talk about the project plans, those type of things. And they started calling me John Synergy, which I thought was pretty funny, and they basically, you know, put it in a superhero light for whatever reason. So I envisioned what the shirt would look like that I would wear, and this is it. Okay. So let's talk about the takeaways from this. Obviously, these are some of the keys that themes that we've been talking about throughout this presentation. Move fast. Rapid decision making using the 80-20 rule is very critical. Focus on integration first, then you can focus on optimization as well. You don't want to have things lingering too long. You don't want the rumor mill to run. You want to be decisive and move forward. Simplify and streamline operations. Focus on key risks and develop mitigation plans. As we discussed, this is often not ignored per se, but not given the type of weight that it should. I certainly think that this is very critical to the process. Perform timely, comprehensive change management. Communication is absolutely critical, and I think that over-communication is the key. Implement a disciplined approach with strong project management. Project management will prioritize, apply resources, will help make decisions, those type of things. And then finally, establish a high-performance dedicated team. Dedicated being the operative term. Focus on the integration is a critical thing. Okay, with that, we'll move into our Q&A.
Thank you very much, John. We do have a good number of questions, and we look forward to this interaction. If anyone has additional questions, this is the time to submit them in your webinar panel area. John, I'll turn it over to you to review these questions. John?
Okay, so I have a question. Yes, hi. What do you think is the most important element to an integration? Well, I would say, there's a number of things that go into that are critical for an integration. You can apply terms such as, disciplined. You can apply terms such as organized. You can focus, those type of things. But ultimately, decisiveness is very key. However, I would add that all these elements that I just discussed, which I just brought up, all are components of leadership. Leadership is the most critical component of integration. If without strong leadership, strong ability to make decisions, ability to have people follow you through a very difficult, challenging time, your integration will have a high likelihood of failing. Okay. Let me see here, some other questions. What are some red flags that an integration is failing, and is intervention possible once failure sets in? Wow, good question. All right, so some obvious red flags are when people start jumping ship. If you have some key people and you're starting to lose them, getting some high turnover, it's very vital that you get involved. You employ maybe you start communicating, maybe more. Maybe you employ retention plans for those particular individuals that you have left that you have not applied those retention plans to. So that's an example of turnover is an example of a red flag. Additionally, say you start losing customers. There was one integration we were on where one customer wanted to pull out because of some of the rumors they were hearing. And all it took was the VP of sales to go to that customer and explain what the integration was doing. And it should have been handled initially in a communication plan, but it wasn't. But once that communication was done, we were able to keep that customer. Okay. Let's see. Which work stream is the most fragile or needs the most care? To that end, I would say HR needs to have the most care. people's jobs are at stake. A lot of times during these type of changes, nerves are very high, tension is really high. There's a lot of speculation. There's a lot of rumors going on. Defining the future state org, communicating effectively with your people, putting in processes in place to avoid unnecessary turnover, those type of things are very critical. So without the people that you rely on to run your business, you're going to be dead in the water, and it's sometimes just as simple as communicating effectively. Okay, well, I think that wraps it up for now. I appreciate your time. Thank you for everything.
Great, and thank you very much, John. It's great having your expertise. And John is also available online. His email is on your screen at this time. Also, you can go to oxys.com and view the additional webinars in our corporate performance series. And thank you also to all our attendees and participants for joining us today and the time you spent with us. We will have a replay link sent to you along with a copy of the presentation, and we hope that you enjoy the rest of your day.